Hello, dividend growth and value investors. I am back again. I must say, my vacation was awesome and the break has done me really well. But oh boy, a lot has happened since my last video because the S&P 500 went officially into bear market territory. This also means that a lot of stocks became attractive again, but more about that in some of my upcoming videos. Because today, I would really love to have a brief look into Altria. The company was in the news again this week and that led to an additional 8% drop in a single day, which makes it now a 20% decline in just the last months alone. Hence, in this brief video, I would like to share with you what's going on with Altria, my thoughts about the situation, and ultimately what I think it's worth paying for. Ready? Let's get started. But let's introduce Altria a little bit for if you actually don't know what the company is about. Altria is the producer of Marlboro in the United States. It became the sole producer of Marlboro in 2008 after it spun off Philip Morris International. And this is important to know. So everything outside of the US from the Marlboro brand is being sold by Philip Morris International. It's a different company that Altria spun off back in 2008. But besides that, Altria is also the owner of US Smokeless Tobacco Company, the maker of Copenhagen and Skoal. They also own John Middleton, a manufacturer of black and mild cigars. But this is not where it stops because Altria also owns the exclusive commercialization rights to the IQ OS tobacco heating system. But hey, this is what it directly owns. On top of that, it has also 3 strategic investments. This is Up InBev, in which it holds a 10% equity stake since the merger of Bud and Up InBev in 2016. Later on in 2018, it also took a 35% equity stake in Juul Labs, and it owns a large part of Kronos Group. And this makes it the total portfolio of Altria, both from direct ownership and equity stakes, as how we know the company today. But you know, the performance over the last 5 years went really nowhere. And this is actually something that Altria is really transparent about, because since 2016, an investment in Altria from a total cumulative shareholder return point of view effectively earned you nothing. 5 years long, it was dead money, while the S&P 500 went 250% higher at the same moment in time. But you know, at the same time, the share price from Altria went from $80 to $43 where it's trading today. But look, with where it's trading today, maybe it just became a really interesting investment case right now. Because if you look at it, right, Altria over the last, let's say, since the spin-off from Philip Morris, has been able to grow its revenue continuously until where it's today. So from 18 billion or 16 billion in 2008 to 21 billion right now. At the same time, which is also really interesting, it has been able to continuously increase its gross profit ratio from 48.2% where it was in 2008 to 66% right now. It shows a certain strength of the company because this you can only usually achieve via price hikes, and only great brands can continuously hike prices. So having said that, in my opinion, if we want to understand more about what is happening then and what has happened over the last 5 years, we will really need to go back to the core job of a CEO, and that is, can it make the right capital allocation decisions? So let's have a look at that. So there are typically 5 capital allocation decisions that a CEO can make. The first one is paying us as shareholders a dividend. And look at that, the company has been doing this really well because in the year 2012 it paid us a dividend of $1.7 and nowadays $3.6. That's more than double the dividend in just a decade time. And you can see it has been growing its dividend on average with above 8% over the last 10 years. Although we can now see that since 2020, the dividend hikes were a little bit less than they were before. So the trend has definitely been broken. But look, this is what I really like. For me, this is really chart porn. Since the spin-off of Philip Morris, and you need to know, Philip Morris is also paying a lot of dividends, the dividend is effectively again back where it was. But if you would have held the Philip Morris shares after the spin-off, you would have done much better because it would have been the typical exponential growth, dividend growth charts, as like how we know them from Johnson & Johnson. So dividend-wise, great capital allocation decisions. If we then look at it from a repurchasing point of view, because a CEO can also decide to do share buybacks, right? This is also something it has been done continuously. And what you can see here is that every day, on average, let's say, it has been reducing its shares by approximately 1%. So what I like about this, that over the last 10 years, it has been reducing its shares by approximately 10% if we consider the shares outstanding back in 2012. But what is important here is then to see like, okay, how is it doing this from a free cash flow point of view? So free cash flow in 2012 was 3.8 billion at the time, and it grew to 8.2 billion right now using the trailing 12 months numbers. Over time, as you can see, it has been quite prudent in free cash flow payouts because, this was the time of zero interest. It could have leveraged up on that extremely, just to buy back shares, but it hasn't been doing that. If you look just at the dividend and the buybacks in total, we can see that they paid out just 1.5 billion more than the entire accumulation of all the free cash flows over the decade. For me, this shows really strong capital allocation from a dividend and buyback point of view. It has not been leveraging all the way up just to satisfy us. But there are a few other capital allocation decisions that the company also needs to consider, and that's pay down debt. Also here again, in general, it is focused on paying down debt. What we can see here is that the debt was 12.4 billion in 2012. They reduced it in 2018 to 12 billion itself. In the meantime, it did some investments. As we know, also the up InVev was happening here. But then in 2019, the debt really blew up because suddenly they have 15 billion more in debt. And this is mainly because of the Joule Labs investment at the time. More about that soon. But as you can see, since then, it paid already 1.5 billion down until today. So then the other one is investing in our organic growth and M&A, right? And this is something we can take from the free cash flow statement. So if we look at it, it is hardly doing any capital expenditure. So it's really not investing a lot back in its business. Yeah. So you need to take this into consideration. What it also tells me is that this is a company that depends more on mergers and acquisitions to find new future growth channels. This is really important because that means that we should also judge the CEO and the board of management solely on these decisions when it comes to finding new growth into the future. This is also where we see that they made an investment, and this is again the investment in Joule Labs, which required 12.8 billion in financing, and the year after 1.9 additionally. So in total, we're talking here about approximately 14.7 billion in capital investments in Joule Labs and also in Kronos. But to sum it up, if we look at the recent history of the last, let's say, 14-15 years of mergers and acquisitions, you can see a Kraft Foods spin-off, which is currently today known as Kraft Heinz Foods. Of course, also the Philip Morris spin-off, which I believe has rewarded shareholders handsomely. But then the Kronos Group and a 35% investment stake in Joule Labs. So if we look at this, I would like to evaluate what the investments since 2018 have done. Because typically where this ends up, it ends up on the asset part of the balance sheet or in the goodwill if the company overpaid for it. If anything in the estimates of the valuation of these assets changes over time, they will need to reflect this in their annual reports, and they will need to also reflect it in the income statement of the annual report. So let's have a quick look in how these investments have been formed over the last 3-4 years. Now, this is where the fun starts. Remember, the company buys Joule Labs in 2018 and straight away it is hit by an 8 billion write-down on Joule. Unbelievable. This is for me one of the worst investment decisions you can imagine. Of course, probably unforeseen events and everything. Well, we know already what happened here. It's not a surprise. So to see this kind of impairment on a single investment you just made within 12 months before is really insane. But if we then go to 2019, right, or 2020 report, what we can see here, up InBev again, 1.5 billion write-down approximately, but another write-down into Joule. It is now just worth 1.7 billion instead of 4.2 billion. Really poor decision, as you can see. Let's go to the last report, and what we can see here, another 5 billion or 5.5 billion write-down on up InBev. Now, that up InBev is being written down. It shouldn't come as a surprise because if we look at it, they made the merger around 2016 when it was trading at €100 it's now half that price. So it shouldn't come as a surprise that the company has been heavily writing down on AB InBev. That this is reflected in the income statement is not really an issue, because what we can see and what we have seen in the cash flow statement, that free cash flow was really stable during these times, because these are non-cash impairments. So from this point of view, you should know that if AB InBev would go back to 100 euros again in the next 2 years, you will also see really large increases in the earnings per share numbers, or at least in the GAAP numbers, because they will need to facilitate for this again in the balance sheet, and hence that travels through the income statement. But what really concerns me is Jules Labs, because the news that really hit this week was that the FDA has banned all of Jules Labs vape products from the US market in a widely anticipated move. So effectively, there's a full ban on selling Juul. Now, what's important here, that Juul was not already sold off. It was just a really small part of revenue. But what concerns me a little bit here is that the FDA rejected it based on the fact that Juul's applications had insufficient toxicology data on its so-called e-liquid pods. And it goes on because the FDA said that it had conflicting data on harmful chemicals leaching from the pods and their genetic toxicity. The agency said it therefore wasn't able to assess the toxicity risk of Juul's products. This is really important to know. So it is not that the agency says it's bad and that's why it needs to be banned. There's no proof, no correct data that they can judge on. This is important because this means that, as we can expect, that Juul said it would seek a stay of the FDA ban and consider appeals. So what this really means is, if Juul gets its act together, then maybe it can lift the ban. But honestly, this will probably take more than a year, knowing how these processes go, and they might even end up in the Supreme Court. We have seen this before with Bayer and other companies. This is a lengthy process, so don't hold your breath. So the question then now remains from an investment point of view. There's almost nothing left from Juul's investment on the balance sheet. Future cash flow from this product, you can forget. Luckily, it was already not so much. So effectively, they wasted 13 to 14 billion of shareholders' money, which of course could have been paid to us in dividends. I don't like this. CEO bad here in their allocation strategy. But okay, shit happens. What's the valuation? Is it worth paying at the moment $43 for? So to assess that, let's go to my dashboard and let's have a quick look into this. So what we can see here is that the payout ratio is healthy with an 80% payout based on the free cash flows. The dividend has been growing steadily, so all good there, check boxes all in place. If we then look at it, I mentioned before the free cash flow has been quite steadily over the last 4 or 5 years, while net income, because of all these impairments, have been of course really looking bad. Look at here, 2019 when the first impairment already came in, of was it 8 billion or something like that. That's why you see this big difference. It was a non-cash impairment. Now, if we then look at it, since the spin-off of Philip Morris, it has been growing its dividends. It did it with an 8.9% over the last 5 years, but look at this. You can get the company at the moment with an 8.3%. This automatically asks us, is this a yield trap? Now, honestly, if we look at it, I don't believe it is a yield trap. However, the dividend safety, as how it was, for instance, 3-4 years ago with the investments in Juul and such, and now with all the impairments, it's not the same. I find the dividend safety rather questionable. I don't know if the company will continue to make these kinds of mistakes, whether we will see a growing dividend over the next 5 years to 10 years. And that's the investment horizon that I take when making investment decisions. So there's definitely an increased risk, and therefore, in my opinion, it shouldn't come as a surprise that a tobacco company is trading above 8% yield right now. So if we then also look at it from a forward price to earnings, it is expecting to earn approximately $4.85 over this year. So that gives it a forward earnings of 9 and also a price to free cash flow of approximately 9 to 10. What I really like in this, that the credit rating is still A3, which is still good investable grade, and that the return on invested capital is way higher than the weighted average cost of capital. Well, the issue here is it's not investing a lot. As we saw, almost nothing in the capex, hence it should also come as no surprise that these return on invested capitals are really high. Now, what we need to look at a little bit is the debt to equity, but the equity stake is going down, so we're talking here about negative equity. This has to do with share repurchases and some of the write-downs in the investments. So although it's flagged red here, I'm not so concerned about that. So if we know all of this, it looks actually relatively good for a tobacco company if you compare it to other tobacco companies. Let's do a fair value calculation. So if we look at the last 4 or 5 years, I have decided to take 7.6 billion as my baseline for calculation, for calculating the future cash flows, because I honestly don't trust necessarily the last 1-2 years in free cash flow, so I want to be in the conservative side. Having said that, let's use the 7.6 billion at a 4% growth rate. I don't expect this company to grow fast at all. And then 2% in the 6 to 10 years thereafter, and I'm increasing the discount rate. Usually I do with 10%, but I do it with 12.5% because this will be my margin of safety. There's an increased risk for the company that I really want to anticipate for. If we then also take a terminal multiple of 12, which is much higher than the PE ratio, forward PE ratio today, I believe that the company should be worth $45.74. If we take a little bit higher growth rates of 5% and 3% and the terminal multiple of 14, it should be trading at $52. But if the growth is really weak and we're talking about almost dead money and 2% and 1% and a terminal multiple of 11, we'll talk about $40. Hence, the average of this makes my fair value $46.21, which means that the company is currently undervalued by approximately 7%. So if we look at it from that point of view, I definitely think that Altria today is a buy. So what am I doing then? Well, honestly, I'm not buying it. 2 reasons for this. First of all, my wife doesn't want me to own tobacco stocks. If I would buy them and put them in our portfolio, I would be in serious trouble at home. Secondly, I honestly don't have a lot of trust in the board of directors. How they're dealing with Schul Labs, for me, is really showing incompetence. And from that point of view, I'm much more a fan of British American Tobacco. I will put a link also in the description of this video to one of my recent videos about that company. I think that company is really on it, has a really good strategy and is executing very well. This is not the case for Altria, and for me it's not worth the additional few percent in dividend yield. Having said that, if you like this video and you want to see more of this, check one of the 2 videos that's popping up currently on your screen. Adios, my friends.